Welcome to the Deep Dive. Today we're diving past the noise of the daily market headlines, and we're definitely skipping the hot stock tips.
Hmm.
We're going straight to the architectural drawing board. We are not talking about speculation today.
Not at all. We are talking about the underlying science of building wealth that lasts.
That's right.
That's right. Our mission in this deep dive is built around sources detailing the fundamental principles of asset allocation and portfolio management.
Right.
So if you've ever wondered how, the largest institutions or the most successful private wealth managers structure wealth to survive for decades, not just for a few quarters, this is your complete roadmap.
This analysis really gives you the ultimate shortcut to being well-informed on structural finance, and the sources are definitive. The big question we're tackling is, I think, the most important one.
It is.
We want to uncover why the single biggest investment decision you'll ever make isn't what individual stock or bond you purchase, but how you architecturally divide your entire pool of money.
How you split the pie.
Yeah, how you split that pie. So let's unpack the blueprint.
To really understand the blueprint, we have to start with the definitions. I mean, these are terms that get thrown around a lot and often get confused.
Okay.
At the highest level, we are dealing with asset allocation. This is the crucial top-level process of deciding how to distribute an investor's total wealth into different asset classes.
So it's the first big decision.
It's the first and most foundational choice that really defines the portfolio's entire risk capacity.
And when you say asset class, we're talking about more than just a vague category,
Yeah.
right? An asset class is a collection of securities that share similar characteristics.
Right, similar attributes.
And most importantly, they exhibit similar risk and return relationships. They're all sort of sensitive to the same big economic forces, so they tend to move together.
Yeah, as a unified front. And historically, we structure these into the three broad classes everyone recognizes. You have bonds, which represent debt.
Mhm.
You have equities, which represent ownership. And then you have cash, or things that are very cash-like.
But that's just the 30,000-foot view, isn't it? I mean, the analysis gets incredibly granular really, really quickly.
Oh, absolutely.
I think the granularity is where people start to see the complexity of, professional management. You don't just write down 40% to bonds in your plan.
No, not at all.
You have to break that allocation down into subclasses.
Precisely. A broad class like bonds is split based on the credit quality of whoever is issuing them. We can divide bonds into highly stable, government-backed treasury bonds.
The safest of the safe.
Exactly. Then higher yielding but riskier corporate bonds, which carry, credit risk related to that specific company. And then at the far end of the risk spectrum, you have junk bonds.
Which are high yield for a reason.
Right. They're high yield but also carry a significant risk of default. The decision to include just 5% in junk bonds versus 5% in treasuries drastically alters the volatility of that entire fixed income slice of your portfolio.
So that structural choice, how you divide the pie, brings us to the empirical evidence. And this is where the conversation shifts from, theoretical to truly foundational.
Yeah.
Why do finance professionals consistently stress asset allocation over, say, stock picking?
Because the data is just overwhelming. I mean, allocation is considered the most important investment decision precisely because it majorly influences the performance of portfolios in the long run.
Right.
It outweighs the returns generated by the two things most retail investors focus on: selecting individual products or attempting to time the market.
Here's the data point that truly underscores this. Our sources cite research that shows, for a single professionally managed fund, the asset allocation decision alone explains a massive 90% of the fund's variation in returns over time.
90%. It's a huge number.
It's staggering. That means the fund manager could pick the 10 best stocks in the world. But if their foundational allocation, say 80% equities, 20% bonds, is just wrong for the market environment, the fund's overall results will be dominated by that structural decision.
And let's unpack the difference between that 90% figure and the next statistic, because this is something that often confuses people.
Okay.
Across all different types of portfolios, so comparing a conservative retirement portfolio to, say, an aggressive hedge fund asset allocation explains an average of 40% of the variation in returns.
Okay, so why is that 90% figure so much higher for a single fund compared to the 40% average across all these different portfolios? What does that fundamentally tell us?
Well, it tells us two distinct things. The 90% figure reflects the constraints of professional active management. If a fund is defined as a global equity fund, for example, the manager is constrained to stay, say, 80 to 90% in global equities. Their variation in performance is almost entirely determined by how they allocate within those equity markets.
So they can't just suddenly switch to 50% bonds if they get nervous.
Exactly. They can't. So the 90% tells us that for managers playing in the same sandbox, the structural setup within that sandbox is basically everything. The 40% figure, on the other hand, is what matters most to the individual listener because it compares the outcome of completely different investment approaches.
Okay.
Even across vastly different strategies, comparing a real estate-heavy portfolio to a stock and bond-heavy portfolio allocation is still the single largest determinant of your outcome variability over the long term.
So the mix is more influential than the specific ingredients.
That's the key. It reinforces that idea perfectly.
So the immediate actionable takeaway here is, if you feel overwhelmed by researching thousands of stocks or bonds, just take a deep breath. Your first and most important decision, the one that dictates the overwhelming majority of your long-term success, is structural. Just defining that asset mix.
Moving from the what of allocation to the how of making it safe and effective, we have to talk about the core mechanism of safety: correlation.
Right.
Correlation measures the strength and direction of the relationship between two different assets. It's what allows us to mix assets together to reduce the overall bumps in the road.
It's a simple scale, but it's essential to grasp because it is the engine of diversification. The correlation coefficient is always measured in the range of -1 to +1.
Yeah.
So if two assets have a correlation of +1, that's a perfect positive relationship. If stock A goes up 10%, stock B goes up 10%. They're marching in perfect lockstep.
Right. And a correlation of -1 is, the theoretical ideal for risk management. It's a perfect negative relationship. When asset A goes up, asset B goes down by a corresponding amount.
So if you could hold two assets with a perfect -1 correlation, your portfolio would have zero volatility.
Theoretically, yes, though that's extremely rare to find consistently in the real financial world.
So the goal for effective diversification isn't necessarily finding that mythical -1, but rather combining assets that just exhibit low correlation, meaning they don't always move together, and ideally they spend some time moving in opposite directions.
And this brings us to the key principle of risk management. Securities within the same asset class, they usually have high correlation.
Why is that?
Because they're all sensitive to the same major economic and investment factors. If the Fed raises interest rates, it negatively affects all high-growth tech stocks at the same time.
So buying 10 different tech stocks isn't really diversification.
No, it's concentration disguised as variety.
True diversification, then, requires combining different asset classes. This is the classic mix of stocks and bonds.
Exactly.
Stocks thrive when economic expectations are high and interest rates are low. Bonds, on the other hand, often provide stability or even go up during a downturn because investors flee to safety.
And that low or negative correlation between the two creates the stabilizing effect. That's the core benefit.
So when one part of your portfolio is having a bad time, another part is cushioning the blow.
Which reduces the total depth of the loss and, maybe more importantly, makes it psychologically easier to stay invested and not panic sell.
However, and this is a huge warning, we need to talk about the stability of this relationship. This is perhaps the most important caveat in modern portfolio theory.
It's absolutely critical.
Investors have to recognize that correlations do change over time. What the data shows us about the last decade might be completely irrelevant in the next one.
This is so important. During periods of extreme stress, or what we call regime change, like high, persistent inflation correlations often spike dramatically toward +1.
And in those moments, the safety net just disappears.
It vanishes. Everything falls at once because the overriding factor, whether it's panic or the need for cash, just dominates the specific characteristics of the assets.
Can you give us a practical example? I mean, when did the conventional wisdom on this fail most dramatically?
Well, look at the 2008 financial crisis. Historically, real estate and equities had a moderate, sometimes low correlation.
Right.
But in 2008, the panic was so widespread that all risky asset stocks, corporate bonds, commodities, real estate, they all plunged simultaneously. The diversification benefit just evaporated.
Because the regime of extreme financial stress just overrode the usual market dynamics.
Exactly. So you can't rely solely on static historical data from a spreadsheet. You have to take changing regimes into account. You need a dynamic view of risk, not a passive one.
So if asset allocation is the scientific blueprint, Then the portfolio management process is the complete construction sequence.
Yes, the process to build and maintain the structure over time. The entire framework is broken down into three main elements: planning, execution, and feedback.
And the very first foundational step in this planning phase is the development of the investment policy statement, or IPS. This isn't just paperwork, is it?
No, it's the contract the investor makes with themselves or with their manager. It's the roadmap that guides the entire investment process. It's the single most important document, I would argue,
Why is it so important?
because it defines success and failure, appropriate risk levels, and acceptable boundaries before a single dollar is allocated. Without a defined IPS, all your decisions become reactive and emotional.
So let's detail what has to be in this roadmap. It needs to specify your investment objectives.
Yeah.
What are you trying to achieve? Your goals, when, and how much.
And your constraints, what prevents you from taking certain risks, and your preferences, what assets do you prefer, and crucially, the risks the investor is actually willing and able to take.
The IPS seems to serve a really important dual protection function.
It absolutely does. First, it helps the investor maintain realistic return expectations. If a client says they need a 12% annual return, but the IPS mandates a 50-50 portfolio that historically returns 7%.
The math just doesn't work.
Exactly. The IPS immediately flags that the goals are impossible under the current risk parameters. It forces a difficult but necessary conversation right at the start.
And second, and this is critical when you're working with an advisor, it protects the investor against their own behavioral pitfalls. It guards against inappropriate decisions.
Or even unethical behavior by a portfolio manager. For example, if your advisor suddenly pitches some highly illiquid, risky private equity fund, but your IPS explicitly outlines a focus on liquidity and capital preservation, the IPS becomes your documented defense against that kind of mission creep.
But the IPS isn't set in stone, right? I mean, it has to be revised.
It must be. It has to be revised periodically because, naturally, investors' requirements change over time. This isn't just about reviewing performance, it's about recognizing major life events.
Like a career change, an inheritance, getting married, having kids. All these things fundamentally alter your ability to take risk, your time horizon, your need for cash.
Exactly. If you drafted your IPS 10 years ago when you were single and just starting your career and you haven't updated it, you are driving your financial life with an outdated map.
So once the blueprint, the IPS, is established, the remaining steps guide the actual execution.
Right. Step 2 involves studying current financial conditions and forecasting future trends. This is where market reality meets your personal goals.
So experts look at macroeconomic factors, interest rates, inflation, geopolitics, to form an educated view of which asset classes might do well.
Then step 3 is the actual portfolio construction. This is building the portfolio by matching specific assets to the IPS, making sure it respects all your objectives and risk appetite.
And finally, step 4 is performance measurement and evaluation.
The feedback loop.
The feedback loop. It's a periodic review to make sure the portfolio remains consistent with your objectives and the target allocation you set out in the IPS.
So the IPS process begins with a really rigorous deconstruction of the investor. We need to translate their hopes and fears into measurable objectives and constraints.
Right.
Objectives are identified primarily in relation to three things: risk, return, and liquidity.
And these three elements are in a constant state of tension, aren't they? Risk and return typically have a positive relationship. If you demand a higher expected return, you just have to accept a higher level of risk.
There's no free lunch. There's no enduring mechanism to consistently generate high returns without exposing capital to potential loss.
Then you introduce the cost of liquidity. If you invest in assets that are difficult or slow to turn into cash illiquid assets, you face the illiquidity risk premium.
Which is the additional expected return the market requires to compensate you for locking up your money and sacrificing that ready access.
Can you give a concrete example of that? How much more return should an investor expect for that sacrifice?
Think about the difference between a highly liquid ETF you can sell instantly versus, say, investing in a private equity fund.
Okay.
That private equity fund might lock up your capital for 5, maybe 10 years. To compensate you for that severe limitation, the illiquid asset typically needs to promise an extra 2% to 4% annual return above a comparable public market investment.
And if that premium isn't there, you probably shouldn't accept the illiquidity.
Exactly. Beyond these trade-offs, we have to identify the general investment goals. Investors usually fall into one of three categories: preservation of capital,
Keeping what you have.
regular income, which is generating cash flow, or capital appreciation, long-term growth.
So if the primary goal is income, The allocation has to be heavily tilted toward things that reliably generate cash.
You're focusing on dividend-paying stocks, interest-paying bonds, or rent-paying real estate. The priority is consistent cash flow.
Conversely, if the focus is purely on appreciation, like a young investor saving for retirement 35 years away, the allocation should be tilted toward high-return investments like equity.
Right, because they can sustain the volatility that comes with seeking maximum long-term compounding.
So once the objectives are defined, we move to the constraints.
And constraints are limitations. They can be personal, regulatory, or structural, and they restrict an investor's ability to take exposure to certain opportunities. They are the non-negotiable borders on your investment map.
And the first major constraint is immediate liquidity needs. This is heavily influenced by your stage of life. Younger people usually have fewer immediate needs for large sums of cash.
Which gives them a longer investment horizon and therefore lesser liquidity requirements than older people who are approaching retirement or facing big, predictable expenses.
Our sources emphasize that investors need to break down liquidity needs into three crucial categories. First is emergency cash,
Right.
measured as 2 to 3 months spending, but maybe 6 or even 12 months if your income is volatile or unstable.
And this money has to be parked in something with absolute security, no chance of capital loss.
The second category is liquidity for near-term goals. Money needed in the next 1 to 3 years, like a down payment on a home.
And that money requires cautious, low volatility investment. You can't put your house down payment in a risky stock.
And the third category is investment flexibility. This is basically keeping some cash or near cash positions to take advantage of market opportunities. It's dry powder.
Dry powder that lets you make tactical shifts or rebalance when things get out of whack.
So if liquidity is a core objective, the simplest solution seems to be just hold lots of cash, right?
Yeah.
But I know there's a huge silent trade-off there.
Absolutely. That is the critical drawback. While having cash feel safe, holding too much of it can severely hit your overall portfolio return.
How so?
By guaranteeing a negative real return after inflation, you risk failing to meet your long-term goals. If inflation is 3% and your cash earns 0.5%, you are losing 2.5% of your purchasing power every single year.
That's a guaranteed slow loss of wealth.
Precisely. And finally, you have the tax constraint. This is complex because different investments in income types, interest versus capital gains, are taxed differently based on your tax bracket and where you live.
A higher yielding bond might look great on paper, but if the income is taxed at 40%, while a growth stock's gain is taxed at 20%, the after-tax return completely changes the calculation.
To illustrate a regulatory constraint, consider the LRS limit for Indian resident individuals. This caps overseas investment at up to $250,000 per year. If you're a high net worth individual, that constraint immediately restricts your ability to diversify globally, forcing you to allocate differently than, say, a U.S. resident who has no such limit.
So once the financial architecture is stable, we personalize the blueprint. This involves setting exposure limits rules to avoid concentration risk.
Which is just a fancy way of saying don't put too many eggs in one basket.
Right. You set a hard ceiling on how much you can have in a single company, a single sector, or even a single country.
And modern portfolio management now systematically integrates what our sources call idiosyncratic concerns.
What does that mean?
These are personal, social, ethical, or cultural beliefs that influence your preferences. For instance, an investor might have a deeply held belief that stops them from investing in companies involved in, say, fossil fuels.
This brings up the difference between two major forms of value-driven investing, which are often mistakenly used interchangeably. The first is sustainable investing.
Right. This involves selecting investments based on environmental, social, and governance, ESG criteria, alongside the traditional financial returns. The focus is on identifying companies that manage these systemic risks well.
ESG provides a measurable three-part framework. Let's look at the governance, the G, for example. This includes evaluating board independence, board diversity, and executive compensation.
Right, and let's ask, why does board independence even matter to an investor?
That's a great question for the listener. Why is that a financial factor? How does that translate into tangible risk?
Well, a board that is fully independent of management is less likely to approve risky, self-serving actions by the CEO.
Like over-leveraging the company for a bad acquisition?
Exactly, or engaging in accounting fraud. Good governance directly translates to better long-term corporate stability and reduced scandal risk.
And in contrast to that systemic approach, we have ethical investing.
This is based primarily on moral or ethical principles. It's much more personalized and often involves strictly avoiding what are called sin areas, so gambling, alcohol, tobacco, and firearms.
So ethical investing is usually done through negative screening, just removing entire sectors based on conviction, regardless of the financials.
Correct. Now, before we get into the psychology, an investor has to have a clear picture of their standing. Goals should be documented meticulously on a goal sheet, specifying priority, time, and the amount needed.
This helps define risk capacity for each goal. We look at near-term high-priority goals, like college tuition in 4 years. Failure there is painful, so it mandates low-risk vehicles.
Compare that with a low-priority goal, like saving for a hypothetical luxury car far in the future. If you miss that goal, it's not a catastrophe, so you can be more aggressive.
And underpinning all of this is the fundamental measure of financial health, the net worth calculation.
Which is just the difference between the market value of all your assets, your house, stocks, bank balances, and all your liabilities, loans, credit card debt. And this should be done at least once a year.
Okay, now let's get into the most fascinating and, frankly, dangerous element. Investor psychology. Asset allocation is about rational math, but applying it is about managing intensely human emotion.
And the BB&K psychographic model is so valued because it tries to bridge the gap between treating investors as perfectly rational robots and viewing them as normal human beings with biases and predictable errors.
It acknowledges that behavior, not performance, is the primary driver of failure.
The model maps investor temperament onto 2 simple axes. The first axis is confidence versus anxiousness. How sure are you of your decisions?
Or how much do you worry after you make a trade?
Exactly. And the second axis is careful versus impetuous. Do you analyze rigorously before acting, or do you react quickly and emotionally?
This maps out 4 distinct personalities. First, the adventurer.
The adventurer is confident and impetuous. They are willing to take large, concentrated risks and often exhibit overconfidence. Their biggest risk is a single catastrophic bet.
Then there's the celebrity. This type is anxious and impetuous.
They're constantly driven by the fear of missing out, the latest hot topic, and they rush into trendy investments without due diligence. Our sources say they are often the most difficult clients for advisors.
Because that anxiety and impetuousness drive rapid, emotional, and often very costly decisions.
The third type is the individualist. These investors are confident and careful. They do their own research. They seek out low correlation assets, and they are often contrarians, willing to go against the herd.
Because they have confidence in their own analysis.
Right. And finally, the guardian. They are anxious and careful. Their single-minded focus is on preserving wealth. They avoid volatility at all costs.
And often accept painfully low returns in exchange for that feeling of absolute security.
And right in the middle, representing psychological balance, is the straight arrow, the well-balanced individual who accepts medium risk for medium return.
So why is it essential for an advisor to know if I'm a celebrity or a guardian if the math in my IPS, my 60-40 allocation, is the same?
Because the math becomes irrelevant the moment a crisis hits. A guardian might see the market drop 5% and demand to sell everything, locking in the loss.
And a celebrity will see their friend touting a stock that has doubled and will liquidate rational positions to jump in.
Exactly. The advisor needs to preemptively structure the IPS like adding cash buffers for the guardian or strict concentration limits for the celebrity to protect the client from their own psychological flaws.
That brings us to the crucial psychology alert. A recent winning streak or a volatile event can cause an investor to temporarily change their personality type.
Oh, absolutely. The careful guardian who just saw their portfolio triple might suddenly start acting like an adventurer, ready to take the next big gamble because they feel invincible.
And the IPS has to be the anchor that reminds them of their original rational risk capacity.
That emotional shift in risk appetite is entirely dependent on one non-negotiable factor, the time horizon. And life cycle analysis is crucial because of the impact various stages have on risk appetite.
Right, and the boundaries are, naturally, fuzzy on a time scale, but the shift in focus is absolute.
We generally break the financial life into 4 major phases. The first is the accumulation phase. This is your early career, maybe 20s to mid-40s. Your net worth is small relative to your future earning potential.
So you have decades of compounding ahead. This is the ideal time for high-risk, high-return capital gain-oriented investments. You can afford the volatility.
Next comes the consolidation phase, typically mid-40s to mid-60s. Your income now consistently exceeds expenses, and your net worth is substantial. You still have a long horizon, but you now have something significant to protect.
So the focus starts to shift toward capital preservation. You begin dialing back the risk to lock in the gains you've made.
Then the third phase is the spending decumulation phase. This starts around retirement. Your living expenses are now covered by your accumulated assets, not your paycheck.
So the focus decisively shifts to stability and, critically, income generation. You absolutely cannot tolerate major losses because you're actively selling assets to live.
Right, any loss becomes permanent. And finally, we have the gifting phase. At this point, the individual has more assets than they require for their own lifespan.
Their focus is now on investing to leave a legacy or support charitable causes. The decisions here are governed less by personal survival and more by estate planning and tax efficiency.
And it's crucial to remember you may be in different phases for different goals. A 35-year-old is in the accumulation phase for retirement,
Allowing high risk. But that same 35-year-old might be in the spending phase for a goal next year, like a wedding. And the allocation for the wedding fund must reflect that short timeline.
So execution is where we synthesize all this. The qualitative insights, your IPS, your personality, with the quantitative reality of the markets.
Right.
Portfolio management integrates the defined investor inputs with capital market forecasts. Historical risk-return data is a good starting point for forecasting, but it can never be the final word.
Absolutely. Past performance is a guide, not a guarantee. But once the portfolio is built, how do you know if it's actually doing well? This brings us to benchmarking. The core idea is simple. You have to compare apple with apple by using a benchmark portfolio that genuinely matches the composition and risk level of your own portfolio.
So if you're invested mostly in large-cap Indian equities, your benchmark would be an index like the BSE 30 or Nifty 50. That's your apple. You have to measure your performance against that.
And the risk of error here is catastrophic. A wrong benchmark can paint a completely different picture. If your manager beats the S&P 500, but your portfolio is 60% bonds, you're comparing apples to oranges.
And that incorrect picture leads to incorrect investment decisions. For complex portfolios, you may need to use hybrid benchmarks, a weighted combination of different indices, to accurately reflect your stable asset mix.
So a hybrid benchmark might be 60% IFTY, 30% government bond index, and 10% gold index, something like that.
Precisely. And just like the IPS, benchmarks aren't static. They have to be reviewed if the nature of the investment or the benchmark's own composition changes.
Let's quickly review the construction principles by asset type, starting with equity. An equity portfolio needs the right mix of risk and stability.
So use large caps for stability and liquidity, and then mid caps or small caps for that aggressive growth potential.
And why the mix? Because historically, for most people, capital appreciation provides the bulk of returns from equities. Dividends are nice, but it's the compounding of growth that's the primary return engine.
Now, when constructing a debt portfolio, the principle is entirely different. Debt instruments are selected by matching the maturity of the investment with the horizon of your goal.
So if you need cash in 3 years, you buy a high-quality bond that matures in 3 years.
And that eliminates interest rate risk because you know you'll get your principal back exactly when you need it.
Hybrid portfolios, those balanced funds, are critical tools, especially as timelines get shorter. They provide an inherent element of stability from the bonds while offering some equity upside.
They're especially useful as a long-term goal approaches to ensure a smooth transition and reduce volatility right before you need the money.
And finally, alternative investments like gold or private equity.
These are added not just for return, but specifically to provide diversification and stability because they often have low correlation with stocks and bonds. Gold, for instance, often acts as inflation protection or a flight to safety asset.
So once the portfolio is built, the final step is maintenance, which revolves around 2 core allocation strategies and 1 crucial action.
The first is strategic asset allocation, SAA. This is the bedrock. It's the long-term target policy portfolio that translates your IPS directly into fixed asset weights, your 60% equities, 40% bonds.
And the philosophy driving SAA is profoundly simple. Time in the market. You set it and you stick with it.
The second strategy is tactical asset allocation, TAA. This is a short-term asset allocation decision used to exploit anticipated market discrepancies within the bounds of the SIA framework.
Okay, so the goal of TAA is to attempt timing the markets by slightly shifting money toward asset classes you expect to outperform soon.
Now, you hit on a key point of philosophical friction. If SAA is about the long-term fixed plan, doesn't TAA kind of undermine that core belief?
It does seem like a contradiction. If my IPS says 60/40 is the right risk level for the next 20 years, shifting that based on a short-term forecast feels a lot like speculation.
It can be. The way professionals maintain integrity is by setting strict boundary limits. TAA is a small tactical tilt, say, plus or minus 5 to 10 percentage points around the fixed SAA target.
So if your SAA is 60% equity, TAA might let you go to 65% if you're bullish, but IPS prevents you from ever going to 80%.
Exactly. TAA is opportunistic, but SAA is mandatory.
Let's use the analogy from the source material to make this crystal clear. SAA is the broad blueprint for a healthy diet from your doctor. 50% vegetables, 30% protein, 20% carbs for life.
That's your non-negotiable health baseline.
TA is like noticing that the market has a sale on fresh salmon this week. So you buy a little extra protein and slightly reduce your vegetable intake.
You're tactically shifting within your healthy diet for a short-term opportunity, but you haven't decided to permanently abandon vegetables.
Now, what ties these two together is the essential action of rebalancing. The need for this arises constantly because of price changes. If stocks have a great year, your 60/40 portfolio might drift to 7/5/25, significantly increasing your risk.
And rebalancing is the corrective action. It's the mechanism that forces you to sell some of the winners, the equities, and buy the underperformers, the bonds, to return the portfolio to its optimal SAA target.
It's the act of checking your fridge at the end of the month to make sure you didn't end up with 90% carbs just because they were cheap. It forces discipline.
But rebalancing involves friction. It's a continuous trade-off between the cost of rebalancing versus the cost of not rebalancing, which is deviating from your optimal risk profile.
And the primary costs are tangible. Transaction costs, like brokerage fees, and tax costs from realizing capital gains when you sell those winners.
And there are hidden costs, too. The most dangerous one is opportunity cost. The risk that the asset you sold to rebalance might have just kept on performing better than the one you bought.
Which is why rebalancing should be systematic based on time or deviation triggers, rather than emotional timing.
And we have to acknowledge the practical difficulty with certain assets. Relatively illiquid investments like private equity and real estate are far more difficult to rebalance. You can't just sell a piece of a building because your allocation drifted 5%.
To wrap up, let's look at the rules governing investment advisors, focusing on client protection as detailed in our sources. This is crucial for anyone relying on professional advice.
A key term here is assets under advice, AUA. This is the aggregate net asset value of securities for which the IA has rendered advice. It defines the universe they are responsible for.
And that brings us to the critical separation rule. An IA is strictly not permitted to accept funds or securities in its own account on the client's behalf.
This is a foundational rule to prevent fraud and theft. The client's money must remain in the client's own brokerage or bank account in their own name. The advisor only has advisory access, never custody.
Another key element is removing conflicts of interest. Our sources state that IAs shall, wherever available, advise direct plans only.
And direct plans are non-commission based. The advisor doesn't get a kickback from the fund company for recommending them. It mandates that the advice is based purely on the client's best interest, not on a sales incentive.
And lastly, what happens if the relationship sours? There are rules on termination fees. If a client ends the agreement prematurely, the IA can retain a maximum breakage fee of not greater than 1/4 of the fee for the remaining service period.
This specific cap is important because it prevents abusive contracts that lock clients in with huge penalties. It provides a reasonable boundary and a pathway out if you're dissatisfied.
We've covered a tremendous amount of ground in this deep dive, from the fundamental math of portfolio science to the intensely human psychology of decision-making. You now have the full blueprint.
Let's do a rapid-fire recap of the core takeaways. Remember the investment policy statement, IPS. It is your documented roadmap, the non-negotiable contract that protects you from market whims and your own impulses.
Remember the data. Asset allocation explains up to 90% of a single fund's variation in returns. It is the single dominant variable. Focus on the mix, not the cherries.
And remember, correlation. Combining asset classes with low correlation is the mechanical key to successful diversification. It ensures that when one part of your portfolio is down, another part is cushioning the fall.
We spent a lot of time on the BD&K psychographic model, defining the adventurer, the guardian, and the celebrity. And we noted that market volatility can temporarily change an investor's personality.
Right. If you reflect on the entire system, from the fixed SAA to the documented IPS, it is fundamentally designed to protect the investor from themselves during times of intense emotional pressure. The system is designed to introduce rationality when the human mind is most vulnerable.
So here's our final thought for you to chew on before you go. If you currently identify as a straight arrow or a careful individualist today, what sudden market event, a deep global crisis, or maybe a massive unexpected winning streak in a small part of your portfolio, what would it take to temporarily push you toward the impulsive and fearful celebrity quadrant?
And critically, how does your documented investment policy statement plan to save you from that temporary impulse?
The true blueprint of wealth is the document that saves you from your own worst enemy, your emotions. Thanks for diving deep with us.
We'll catch you on the next deep dive.